investment philosophy in one word, and I'd say it's buy great companies and hold on. With Prescient Securities, so that was 2009, and then I was, I guess, working in association with them, and then in 2013 there was a requirement from, request from my colleagues at Prescient to have a balanced fund, and that time period was where balanced fund shifted from being the investor was looking after meeting their Reg 28 exposure to the trustees were responsible for it. So we needed to launch a Reg 28 fund to go onto the sort of Prescient's Provident Fund. So that's where the managed fund started. I bought the FSP from Prescient Securities 2014, and it kind of all went through in 2015. So since 2015, it's been Long Beach. And I think when I bought it from Prescient, there was 35 million between the two funds, and now we're up to 650 million between the two funds.
Yeah, it's amazing. Is the reference the name Long Beach because you live in Long Beach?
Yeah, surfer by heart.
Yeah, it's very difficult to actually naming a company is pretty tricky because anything you can think of that's kind of whiz bang has been taken already. And then actually I remembered I worked with Andre Milan at Fairtree many years ago, and I remember him telling me that he lived in Fairtree Road in Durbanville, and so he called the company Fairtree. I thought, well, I live next to Long Beach. That's a pretty good name, and it's worked out well.
Brilliant. Wow,
it's been quite, I guess, kind of within the sort of finance sector. At the time, it was unusual. Now, if I look at some of my competitors' names, that says that style of name has become more common.
Yeah. Okay.
It's authentic, and that's really something special,
Yeah.
Exactly.
I guess it's worked well in terms of being personally associated with me. And he doesn't want to retire and sit on the beach, so
for sure.
Yeah.
So I mean, in terms of then when it comes to like how your investment philosophy, how you think about that, like bigger picture, number one, and then secondly, when it comes to building portfolio and portfolio construction and selecting the underlying securities and the stocks, etc. I mean, what's kind of your approach there? If you could just give us a little bit of insight into that.
Sure. Sorry, maybe I should just jump back on the in terms of Long Beach kind of, and just let you know sort of how it's set up. So Long Beach is sort of, let's say I'm the key individual on Long Beach's license. I'm the portfolio manager for both of the Long Beach funds. I have on a financial accountant who I've engaged with on a consulting basis. So she looks after all of Long Beach's accounting, management account, tax, audit, those sort of things. I use Moonstone for compliance. So again, outsourced compliance to Moonstone. Both of the funds are white labeled through Prescient Manco. And then Prescient Fund Services does the administration. And they also do client onboarding to the funds. And then recently Alyssa's come on board to help me with marketing.
Okay, cool.
Yeah. So, and then I do have, so being a sort of a sole prop or a sole portfolio manager, I do have a legally defined succession agreement. So if I'm permanently incapacitated, then the relationship is with Prescient Investment Management and Prescient Fund Services, but the funds would be taken over. In fact, they get rolled up into Prescient's balanced fund.
Okay. So one of our later questions, that kind of succession, what happens if anything happens to you?
Okay, so that's a legally defined agreement, and that we designed that so that there's no liquidity issues for clients. So even if all of the clients wanted to withdraw, it's coming out of a substantially bigger fund, so that would be easy for the fund. There's not going to be any liquidity prejudice. I do also get a lot of questions about sort of how do I manage it on my own. And I think 16 years later, I think I've probably proven that one. So,
Sure.
yeah. So I kind of I've managed it from all over the show in over 16 years. Yeah.
I mean, there's something I think something to be said sometimes of, when there's one key decision maker, you take full responsibility. Because I imagine a lot of these funds these days are run by committee and consensus, and also within a broader corporate philosophy. Whereas you kind of get to, you live and die by your own sword, I guess, in terms of your decision making, which can obviously work for you as it's done, but you're happy to take on, on that responsibility and risk, I guess.
Yes. Yeah. Yeah, and I think there's also, I guess, because it's both my business and I manage the funds, I've consistently tried to take the best decisions for investors. So I think there have been sort of some of the bigger firms, and when I worked in bigger firms, particularly in difficult market periods, there can be a tendency towards, let's say, managing the fund for business purposes rather than for investment purposes. Yeah, in terms of kind of risk positioning or positioning from a benchmark, etc.
It's always that age-old like shareholder versus client point of view. I mean, the very reason why we left corporate.
Yeah,
exactly.
Yeah, so I try and manage Long Beach for sort of putting the client's interests first. Yeah. I just look at some of those big institutions, the institutional clients, the pension funds and all the like, if you deviating massively from benchmarks, you quickly get fired. So exactly that, to your point, Yeah. And I guess kind of once you've acquired assets, if you sort of adopt a relatively low risk approach, you can kind of just let the cash flow roll. But over time, if you're adopting that sort of approach over time, actually your performance is probably going to dip to below average.
Yeah. Which makes sense. Yeah. Okay. Yeah. Thanks for that kind of insight. So moving on to how you go about it. I mean,
what's your philosophy, core philosophy around it, around
the secret sauce? Why are you doing so much better than everybody else?
The secrets. I've got a magic hat, and I hope the rabbits keep jumping out. I guess my for your quick takes, you were asking for the investment philosophy in one word, and I'd say it's buy great companies and hold on. So I'm looking for a specific economic structure to a company, and then trying to, let's say, hold the investments to let them really have a chance to work and pay off.
And how do you think around that in relation to valuation? Because one of the things that really irritates me, because I listen to a lot of investment presentations and what have you, and it's always about, this is cheap, that's cheap. The only metric that you hear a lot of the guys consistently talk about, it's cheap, but there's no relative to, okay, well, what's the opportunity set and, future growth? A P of 40 could be cheap if it's growing at, 40, 50%, I mean, what's your thinking, how do you balance that with valuation and managing risk and things like that?
So I would agree with you that there can be, let's say, an over, particularly in the South African context, people get very hung up on what a PE ratio or current PE ratio is. And I don't think that I think companies that we invest in are dynamic. So there'll always be things happening within the business that maybe we're not seeing. So that the business could be moving sort of, I guess, either vertically integrating, horizontally expanding into new markets. And so sometimes those, let's say, new business opportunities aren't necessarily captured in a current pricing. I try and think of it more in terms of let's say, a band or a scale. So good companies are always likely to be expensive. Poor companies are always likely to be cheap. Companies with attractive capital structures or attractive economics also tend to be more expensive. Companies which are in low return, high capex, cyclical industries will tend to have low ratings. So I try and think about those, call it economic factors, as well as looking at like a pure number. And then I think the other thing your question you were asking about the biggest mistakes, and I'd say selling too early on a lot of investments over the years was probably my biggest mistake. So I think that in terms of again, in the South African context, people want to buy low PE, it reaches fair value, sell, go and buy the next idea. And to me, that's a lot of hard work. Whereas also, if I have a good idea, I like to let it run. And I think that, yes, sometimes they might get a little bit overvalued. If something gets egregiously expensive, yes, I'd want to sell it. But again, I'm not going to sell it just because it's got a little bit, like if it's 10%, 20% more than what I think it's worth. To sell that, buy something else, look for an opportunity to get back in, I think that is actually dangerous. It's better to stay with the idea. Yeah.
I mean, looking.
So I try and to put it in a nutshell, I try and think of it holistically. So
Yeah.
I don't get hung up on I have to buy something at PE below 10. I try and say, well, hang on, if there's really great cash flow. So I'm looking for capital light businesses, very large market opportunity sets. I like, let's say, small transactions, so small recurring revenue transactions. I like consumer-facing businesses because I think they lock in more than like I think B2C is a bigger lock-in than sort of B2B type businesses. Yeah.
Okay. I mean, speaking to that, if we're just looking, I mean, at a couple of your top holdings, like Cloudflare or DoorDash or Shopify. I mean, just like very quickly, your thesis on, a couple of those names, which, speaks to some of what you said now.
Sure. So those, so the first two, Cloudflare and Shopify, I've actually owned probably for the last 4 or 5 years. So that was, I guess, kind of during the COVID, and that both of them contributed to the volatility in the fund. So both the performance in 2021 and then the weaker performance in 2022. If I look at so Shopify recently, their results were accelerating. So their revenue growth in the latest results was 31%.
Yeah.
They through COVID, they had very, very strong growth, I guess, as everybody was at home spending their stimulus checks. And then coming out of COVID, their revenue growth slowed down to be flat. So then through 2022, 2023, the share price came off substantially because the market viewed this as kind of an ex-growth COVID stock. But it was really, I guess they had pulled forward some growth. And as the COVID numbers normalized, they've now returned back to this 30% revenue growth. And I think they're a good example of a business where they started off doing, call it micro brands, startup brands, providing websites. But because they've got because they're a technology leader, they've been able to move up market. So they're now signing up companies like Nestle and like Starbucks to be, so they've moved up market, and then I guess they're now taking share from incumbent players like Adobe Commerce or Oracle or Salesforce. The other thing with them is so they've also been able to go into B2B. So they've taken we're all familiar with their retail checkout. So if you shop online, you've seen Shopify, there's the Shopify standard checkout page. but they've now moved into B2B. So then that's a new growth driver for them. So I think they're a good example of a company that is innovating, very much constantly innovating, and then that allows them to move into adjacent market segments. Yeah, and I think that if the sort of online retails in China, online retail runs at about 40% of retail spend. In the US, it's about 16. The rest of the world, it's about 12. So there's still a very long way for online retail sales to grow. Through, I guess, coming out of COVID, they also then went into the physical retail store. So they then produce point of sale systems so that a retailer can be fully integrated between both their online and offline retail experience. Yeah, so I think that's a good example of a company that is continually offering both existing customers, their customers, as well as future customers, like additional products and services. Yeah. And I think the other thing with that type of business is that it's, if you've built let's say the switching costs are quite high. So once you've built into their commerce system, it's not, you're unlikely to just switch out of that. So there's a certain, it's a certain stickiness to that.
And I mean, what sort of like research mechanisms you use to kind of to be finding out this kind of information? Because, you know, when you're just looking at models and, you know, like you're talking about, you know, COVID normalizing growth, you know, you could easily just say it's a sell, buy out, but obviously, you know, you're taking this a little bit further and trying to understand where they're going. Like, how do you approach that kind of research?
So I think I try and read quite widely. I used to, well, sort of have a joke that I'm not going to invest in a German chemical company because I can't see or experience their products. So Peter Templeton, who was Fidelity Fund, he used to talk about going to the local shopping mall in order to sort of look for ideas. And I think quite a common theme across our portfolios is that both myself as well as you guys probably interact with a lot of the companies in the portfolio. Yeah, so I mean, I don't know, I'm not going to go and buy a US wealth manager because kind of how am I going to see or feel or experience the products? So I think like I do like to invest in something where I can have some personal interaction with the company's products or services. And again, it's like, I suppose that's like an 80-20. And then I also, let's say I eliminate, I try and kind of focus my research. So I try and think about what both the company's economics. So, and then I'm looking for something really exceptional. Yeah.
I mean, in terms of it's both on the flexible and the balanced fund, you know, it's that onshore, offshore, getting those weightings, you know, allocating capital. I mean, how do you think about that? Because I know a lot of, you know, managers have brought, you know, are overweight SA currently, whereas, you know, on your balanced fund, you look like you're pretty much close to maximum offshore.
Yeah.
I mean, what's your kind of rationale and thinking, how you kind of balance and think about that?
So in the balanced fund, I don't overthink it. I keep it pretty much at the maximum offshore. So over the years, as we've been allowed to increase the offshore exposure, I've pretty much taken it to the maximum exposure each time. And I think that's probably, like, going forward, that's likely to be pretty consistent. So 45% global. Similarly with the equities, I think we're around 73-74% at the moment. And again, I keep it towards the top end of the equity exposure. And that's our clients in the balanced fund are all in, or predominantly in the accumulation phase of retirement planning. So people contributing. I do have a few investors, I guess, drawing down, but the bulk of investors are accumulating. So I am looking to maximize growth potential within a balanced fund. I think in terms of some of the bigger funds, they sometimes get caught between, I guess, two objectives. One being retirement savers who are drawing off their investments and maybe want more of a 60% equity exposure, so even though it's a high balanced fund, they want a slightly lower risk. Whereas somebody who's 40, 30, 40, 50, 60, still planning for retirement probably wants to have the maximum growth. So we sort of unashamedly say we're looking to maximize the growth in the balanced fund for accumulating investors. And then I think the other reason for being fully weighted offshore is really the opportunity set. So I think that being able to invest in global equities, there's just a much greater opportunity set outside of South Africa.
Yeah, okay.
And particularly sort of looking for longer term growth. Yeah.
I mean, I guess to your point, on that basis, you don't mind the additional volatility attached to aiming to maximize growth for accumulation investors, because your fund is, more volatile than most in the industry, but you're happy to do that.
Yeah.
And
we do make it clear that that's what our objective is.
Okay. And who's your kind of?
I guess that's I guess just a quick comment in terms of the, let's say, South Africa or offshore. I think over time, so South Africa's economy does have productivity constraints. So we are in call it a low growth trap at the moment. And I think absent structural reforms, it's likely to stay that way. So I think, yes, there will be maybe there's sort of call it trading opportunities where something there'll be a sort of a period of pessimism, and then there's an opportunity to sort of upweight South Africa. But I struggle to see sort of sustained long-term market growth or economic growth potential, where it's a lot easier to see that. It's a lot easier to see constructive macro environments outside of South Africa.
So is the typical clients in your fund, is that sort of the retail cohort? Because in some ways, I guess you've got such a successful fund, you'd almost expect it by AUM to even be bigger.
So I think the part of the reason the funds haven't got bigger is that I've put very little focus on marketing in the past. So I sort of quietly ran the funds and didn't spend much time chatting to people like yourselves. This year I've decided that I'm going to change that and be a bit more open to chatting to people like yourselves.
Mm-hmm.
Okay, well, no, great.
Yeah, look, it's also different. I mean, it's not just us; it's all the distribution channels that you've got to go through, and it's quite a,
I think, I guess coming back to it's about the focus. So I've always put the focus on the investment performance, and kind of, I guess, restricted access to myself in terms of marketing so that I don't get distracted. And now I am sort of, I guess, being more open to conversations, but still trying to keep a focus on the investment performance.
Makes sense. And do you have any plans? I mean, particularly like you said, opportunity set offshore is so much bigger to like launch a global equity fund, proper offshore fund. Because I think there's so few actual good pure offshore equity funds that South African investors can access. If you look at how many are kind of trailing the basic MSCI World Index performance-wise, what's your kind of views there?
So I have thought about that previously, and I do get a lot of requests for that. So it is something I'm exploring. It's tricky being a small business with the international regulators. But it is something that I'm, I guess, constantly looking at, but I don't have an immediate answer for.
Okay.
Yeah, and I guess really the sort of, I think even Long Beach I was probably fortunate with my timing of starting Long Beach, where I think to start a one-person fund manager now, the FSCA might be a little bit stickier with, but I guess kind of I was fortunate with my timing to get it up and going. You were asking, Carl Peter, you were asking earlier about the client base, and I would say the client base is probably split. It's about a third, a third, a third. So it's about a third retail investors. It's about a third through the platforms, and then it's about a third through institutional products.
Okay.
Yeah. Maybe the retail's like 40% and the other two are 30. Yeah.
Okay, so it's actually quite nice, evenly split.
Yes. And then I would say within no one investor is more than 20%. Sorry, no one investor is more than 10%. So I don't have a sort of anybody over 10% of the asset base, and the asset base is very diversified. So actually, I've got a long tail of sort of smaller accounts.
Okay. That also eliminates some of the risk.
So I think it took a long, I guess, so my growth was slower, but I'm not at risk of losing one client that could potentially jeopardize the business.
Yeah, exactly. Okay.
It's the difficulty around growth, like balancing that growth, and
yes,
easy monies to go into sort of the DFM space, but when they when they switch out, then you have liquidity issues. So
that I did in 2020, 21. I actually said no thank you to one of the big DFMs for that reason, in that I felt that they would sort of potentially would swamp me. In terms of
I know I'm conscious of time, but just if you don't mind, a couple more questions and before we finish off. I mean, obviously, all the talk of the town, is all about AI and the AI, boom or bust. Are we in a bubble? I mean, what's your number one view on AI specifically as the technology, and B, kind of the opportunity set as we look out, and also some of the risks maybe you kind of see potentially in the market, or if you do see any risks.
Sure. AI as a technology, I think it's amazing. So I think it is incredible technology, and is probably got a very long runway for integration into businesses and our personal sort of use. I still think it is a tool. So AI is not going to it's not going to replace, I guess, human thought or kind of human creativity. It's still a tool to do things. And I guess the thought, so that if the thought around sort of finance, like if you think about arbitrage theory, if there's an arbitrage gap, markets would quickly exploit that. So I think with AI, similarly, if AI provides an information advantage, if everybody's using public AI, that advantage very quickly goes away. So I think to bring that back to investments, I think companies which have large proprietary data sets are sitting on a significant advantage. So if they can put their proprietary data into a large language model to have insights. So I think it will, like the stronger players will become, even like they take a Shopify or a DoorDash or an Uber, that because they've got the biggest data sets in their business operations, they'll be able to get the best insights, which will allow them to, I guess, cement their advantages. So I think AI will maybe make it more difficult to displace some of the incumbent platforms. I think there's a very significant infrastructure build out taking place at the moment, and probably like any technology cycle, there will be a hardware overbuild. So what am I cautious of? I'm cautious of a hardware overbuild. And that's also, let's say, generating AI models requires a lot of compute, whereas the inference requires a lot less compute. So I would be I'm more looking for opportunities in terms of use of AI rather than build out of AI infrastructure.
Okay. Which I guess speaks to what.
Sorry, Carl Peter, I have a client here. I need to
Yeah,
excuse myself.
Right.
David said, nice meeting you guys. And
sure, nice to meet you, Stephen.
All right, cheerio.
Great, thanks a lot. Cheers. Have a good day.
I guess that speaks to why you don't have any, semiconductors and stuff as your, or any of the hyperscalers as your top holdings.
Yeah, and I think that it doesn't, AI, like it doesn't change the capital nature of those businesses. So it doesn't, like a business where you've got very, very high capex investment. If Meta or Microsoft decide they're going to slow their spending, then Nvidia's revenues are going to take a big hit. So I don't think the fact that it's AI and AI is whiz bang, it doesn't change the capital intensive nature of tech hardware. Because ultimately it is still tech hardware, which is a high capex cyclical business over time, and kind of that's proven whether it was Cisco with routers or fiber optics or
no, absolutely.
It goes through capex cycles, whereas I think to go back to the sort of consumer-facing businesses is that, let's say, so for Microsoft to buy, let's say AMD comes up with an AI chip. So for Microsoft to switch from buying NVIDIA to buying an AI chip, that's a relatively easy corporate decision. And it's going to be based on kind of, let's say, cost factors. It's not going to be based on behavioral factors. Whereas if I'm traveling, for me to switch from using Uber to using another mobility app, the new app's got to be like 10x. I mean, it's got to be substantially better for me to switch. Because of I've got the familiarity of using Uber, understand how it works. I've got there's a consumer experience relationship with the platform. And so an alternative is going to have to be substantially better to create the shift.
Makes sense. Okay.
Yeah.
And then I guess final question. I mean, what keeps you up at night in terms of, thinking about risks as we look ahead? It feels like the world's in a very volatile period, with all the geopolitical risks, all this, the re-onshoring and tariffs, and, then you look at China, Taiwan, the risks attached to that. I mean, how do you kind of think around that and, plan out? I know those black swan events are, they're black swans for a reason, but, model out and think, how those kinds of risks that are floating around.
So I think being negative never really pays off. I think even going back to when I was a kid reading the Time magazine, I mean, I guess the world's never really been a super stable place. There's always been a lot of friction and tension. And I think good companies prosper through that. And because similarly with COVID, like the really good companies use that as an opportunity to get better. So, I mean, does it keep me up at night? Maybe, but not. Am I going to do anything about it? I don't. I think it's difficult to predict the end of the world. So I don't think it's worth sort of betting or positioning a portfolio for the end of the world, because the end of the world never really happens. I would much rather sort of manage a risk-conscious portfolio, and if something happens, respond to it. So whether that was COVID or whether that was the Russia invading Ukraine, like I'm not going to bet on those ahead of time. But when they happen, then yes, I'm responsive to what's happening and adapt the portfolios at the time.
Sure.
Yeah. Okay. And I think another comment that I get quite a lot is about geographic investment, whether to be in the US, whether to be in the rest of the world. And our fact sheets do show up the funds as being quite heavily invested in the US. But that is partly because the ADRs get picked in anything listed in the US gets picked up as US exposure, even though the companies are actually operating elsewhere. So the Chinese ADRs show up as US exposure, even though they're actually China. So it is something I'm talking to Prescient about. But it's a big, the regulator says, well, if it's listed in the US, it's US exposure. But I think our portfolios are quite well diversified around the world at the moment. So we've got Nubank and Mercado Libre in Latin America, Grab in Southeast Asia, Alibaba, Naspers, PDD in China. Yeah, so I think we've got quite a good global spread. And I think that also does help balance the risks a little bit.
Okay, yeah, okay, super. Yeah, I think that's kind of pretty much what I wanted to cover.
Sure.
So I'm very grateful, for your time.
Perfect. Thank you very much.
Thanks so much.
Thanks very
Have a
much.
nice
Have a
weekend.
great day.
Yeah,
Okay.
you too. Cheers.
Bye.